S&P 500 futures are floating completely flat at 7,150, and Wall Street is walking into a massive post-Memorial Day holiday hangover. It is Tuesday morning, May 26, 2026. The bell has not rung yet, and we are cracking open a dense, top-tier institutional playbook for this deep dive. Our mission today is to cut through all this pre-market volume and show you the brutal tug-of-war happening right now between this explosive AI boom and a really stubborn Federal Reserve. Okay, let's unpack this. We're looking at a market firmly stuck in a prove-it phase right now.
Yeah, that prove-it phase is entirely defining the implied open today. I mean, the tape is just incredibly cautious right now. What we're seeing in the data is institutional money aggressively weighing these record-high equity valuations against a 10-year Treasury yield that, well, it just refuses to roll over.
Right.
And the stakes for you today are clear. That era of easy gains where you just blindly throw darts at tech tickers is over. It's fully replaced by this high-stakes battle over liquidity.
Which brings us straight to the macro data, because, you can't trade these individual pre-market gappers if you don't respect the broader environment. Look at the gravity acting on the market this morning. We've got the 10-year yield creeping right up to 4.32%.
Huge headwind.
Massive. And the dollar index, the DXY, is holding firm at 104.10. Plus, inflation remains sticky above 4%, which has the Cleveland Fed eyeing a hike or hold strategy. So no rate cuts. But I do have to push back here for a second.
Sure.
If AI is actually this world-changing generational tech, why does a 4.32% yield even matter to these mega-cap companies? I mean, shouldn't they be completely immune to this kind of bond market gravity?
Well, what's fascinating here is this concept of duration danger.
Duration danger.
Right, because big tech stocks, they trade as high-duration assets. Their valuations are heavily dependent on massive earnings expected, 5, maybe 10 years out.
Yeah, you're paying for 2035 today.
Exactly. So the discounted cash flow models that Wall Street uses are tightening up fast. If that 10-year yield spikes, the present value of those future earnings just drops. The market is shifting violently from a growth at any price mindset to a very aggressive, show me the free cash flow right now reality.
Which gives us our key levels to watch today. For the S&P 500 futures, the ES, your line in the sand support, is 7,210.
That's the April all-time high pivot, right?
Exactly. Holding 7,210 keeps the path to 7,400 clear. But resistance is sitting at 7,325.
And for the Nasdaq 100, the NQ, it's an even tougher setup. Support is 29,100, but resistance is at 30,000. And that 30,000 level is basically a psychological iron curtain today.
Yeah, massive sell wall order sitting right there.
Right, so breaking that in this high-rate environment is a massive ask.
So knowing that high rates are crushing these duration assets, let's look at the actual pre-market movers, because the AI sell the news dynamic is playing out in real time. Look at NVDA.
Yeah, NVDA is down 1.2% in the pre-market.
Yeah, down 1.2%. And that is despite them posting a massive $81 billion revenue beat.
It's a textbook sell the news digestion. The market is chewing on their $91 billion guidance, and frankly, perfection is already priced in.
Right.
Traders see that beat and immediately ask if there's any upside juice left. When the answer is no, they take profits.
But on the flip side, Meta is up 0.8% pre-market. And it's not off ad revenue. This is a multi-billion-dollar custom silicon deal with AWS to essentially escape the merchant chip supply chain.
Which is a huge strategic pivot.
Yeah, it really is. And here's where it gets really interesting. While the big software and chip names are hitting this friction, the physical infrastructure layer, what the playbook calls physical AI, is absolutely booming.
Oh, without a doubt. Wall Street is projecting an $800 billion tech capex spend this year.
$800 billion.
Yeah, it's an AI supercycle stretching out to 2027. And this capital isn't just going to code. It's going to concrete, copper, and cooling systems.
Which brings us to Digital Realty Trust, ticker DLR, up 2% pre-market.
They are essentially the landlord for these Blackwell generation clusters. Institutional money loves this right now because it's defensive growth. You get the yield plus the AI exposure.
And the playbook gives us a bull level of 195.50 for DLR today, but the bear level is 182.00, especially if that 10 a.m. consumer confidence data comes in hot and spikes those yields we mentioned earlier.
Right, because that yield spike will drag everything down.
Exactly. But look at Constellation Energy ticker CEG, up 2.5% pre-market. And the catalyst here is insane. The White House is literally invoking the Defense Production Act to boost grid capacity for data centers.
Yeah, wartime manufacturing laws.
Right. We're using national defense laws just to generate enough electricity for AI data centers. It's wild.
It really highlights the bottleneck. I mean, the constraint isn't chip speed anymore. It's literally, can we keep the lights on while these things run?
Which perfectly transitions us into the macro geopolitical picture, because the power grid relies on global energy markets, and that is entirely driving the pre-market tape today.
Definitely. Look at the Iran catalyst. We've got rising optimism around a U.S.-Iran peace deal, and that is aggressively crushing Brent crude down toward $95.
And a drop in oil is generally a risk-on tilt for the Nasdaq, right?
Absolutely. Cheaper energy acts as a stealth tax cut for the broader market, but, and this is critical, it sets up a massive contradiction in the defense sector.
Right. Look at Elbit Systems, ticker ESLT. They just reported Q1 2026 revenue of $2.19 billion, but the jaw-dropper is their record backlog of $30.2 billion.
Driven entirely by European rearmament and this ongoing Iran friction.
Yeah, so their bull level is 245.00 today, but the bear level is 228.00. Because if those P stocks actually gain real traction, there is massive profit-taking risk there.
Right. And if we connect this to the bigger picture, you see how disjointed this tape is. Oil is dropping on peace hopes, which helps SEC, but defense backlogs show that severe geopolitical tension is already baked into the actual spending.
Totally, completely contradictory.
It is, and then you add in these corporate anomalies like Warner Bros. Discovery.
Ticker WBD, yeah, down pre-market.
The streaming wars have basically devolved into legal wars. Paramount is hiring counsel over M&A terms.
Because in this high-rate environment, no one can afford to borrow the billions needed to actually merge.
Exactly, so they fight in court instead. The bull level for WBD is 14.20, but the bear level is 12.50. And if it breaches 12.50, it's signaling a dead money phase.
Dead money, which means institutions just walk away and deploy that capital elsewhere. So we've covered the macro, the physical AI rotation, the geopolitical contradictions, but here is the most crucial part for you listening today. How is the retail crowd completely misinterpreting this compared to the institutional big money?
Oh, the retail trap right now is brutal. The playbook actually calls it a crowded cul-de-sac.
A crowded cul-de-sac. That's a great phrase.
Right. Retail is just sitting there, completely hypnotized by the AI darlings, buying every tiny dip in the mega caps, totally ignoring the macro gravity.
While the institutional money is setting up the pain trade. So walk us through this pain trade. Because if yields are spiking and the playbook says this is driven by growth expectations, not just inflation, fears, the smart money is actually going to short the consensus.
Yeah, they are rotating out of the crowded mega cap tech trades and moving into beaten down cyclicals and small caps.
Well, wait, hold on. If borrowing costs are at 4.32% and climbing, shouldn't small cap companies get absolutely crushed? I mean, they rely on cheap debt to survive. Why would big money run into the Russell 2000 right now?
Because markets are forward-looking. Yes, high rates punish small caps, but they have been in a rolling recession for 2 years. They've already absorbed the pain. The high-rate reality is already priced into their valuations.
Oh, okay.
Mega cap tech, on the other hand, is priced for absolute perfection. So if you're watching the pre-market volume today, watch the IWM to QQQ ratio, the Russell versus the Nasdaq.
Right.
If yields spike and the Russell holds its ground while the Nasdaq bleeds, that's your signal. The tech leadership era is hitting a wall, and this is a classic gap and go rotation into value.
So what does this all mean for you as you prep your screens today? The market isn't necessarily violently bearish, it's just exhausted. The 10-year yield crossing that 4.35% threshold is going to act as the ultimate referee today. If it crosses, tech sells off.
It's mathematical gravity. You just have to understand this rotation. We are moving from growth at any price to show me the free cash flow. If you don't track this shift, you are going to get caught in that retail liquidity trap.
The big money is moving toward physical infrastructure, which leaves us with a final thought for you to chew on before the opening bell. We just outlined how the Defense Production Act is literally being used to secure the power grid for these AI data centers. So as we look toward the peak of this supercycle in 2027, ask yourself, are the ultimate winners of the AI revolution going to be the software engineers writing the code? Or is it simply going to be the utility companies and industrial landlords who own the concrete and copper required to plug it all in?